With the economy and interest rates causing us all to rethink our investment plans, there may be one avenue you haven't thought of. It's the annuity. Here to help explain the ins and the outs of an annuity, we have Safe Harbor Retirement President Cory Sickles back with us in this sponsored segment. Hi, Cory.
Hi, Robin.
All right, so let's start with kind of this, basic definition. What is an annuity?
Well, basically, when you have an annuity, you're signing a contract with an insurance company. And you can put a lump sum into it, you can make multiple payments into it. And then basically you might be in there for 5, 7, or 10 years.
Okay.
I mean, an advisor should be able to go over that with you. And there's really 3 types. We have a variable annuity, we have a fixed annuity, and we have a fixed indexed annuity. Really what we focus on are the fixed and the fixed index. We really don't recommend variable annuities to our clients.
Okay, so then talking about the 2 that you do recommend, what is the difference between those? What are they?
So when we start talking about a fixed annuity would be, I'm keeping it in there for 5 years, for example, and I'm going to get a certain rate, guaranteed rate, kind of like a CD.
Okay.
Right? So
yeah.
Right now they're paying probably a little over 5%, 5.5% right now. And then we also have a fixed indexed annuity. And a fixed indexed annuity, really what it allows you to do is it allows you to invest in the market, right? But you only get the upside of it. So when the market's positive, you make interest. But here's the most important part of it is when the market's negative, you don't lose anything. And just like in 2022, the market was down around 20%. Clients didn't make any money, but they also didn't lose any money either.
Okay. And yeah, I would imagine, that obviously a benefit, but what are some of the advantages? Why would you recommend this to somebody?
Well, when we start looking at the overall, portfolio, we're looking at allocation. And really what we're trying to do is maybe take some of that lower risk or the safe money and place into the annuity. And a great way to be able to do that is to be able to create your own pension. So you can put money into it. And at some point in time, because pensions are going away, at some point in time, you're going to be able to trigger what we call lifetime income. And then now you're going to be able to actually receive money for as long as you live. And if you do a joint payment, it's going to be as long as you and your spouse live as well. So it's a great way to be able to create some income along with Social Security and some other things where you can count on that on a monthly basis going forward while you're in retirement.
Yeah, and it makes sense. And you talk about kind of the advantages, but are there downsides then too?
There's always downsides. The one thing I would probably say is when you start, comparing the returns you get on the market, the returns aren't going to be as great with a fixed indexed annuity, but again, you don't have to worry about when the market's negative.
Yeah,
and
risk.
And the other part of it is you are signing for a period of time, whether it's 5 years, 7 years, or 10 years. And if you take the money out or take too much money out during that period, you might have what we call surrender fees. But again, if you're working with an advisor, they're going to be able to make sure you're allocated the correct way, so you don't really need to have. You don't have to worry about liquidity because you have other assets to be able to meet your needs in case emergencies do come up.
I was going to say, do you recommend this for anybody in any stage of their investment planning as part of their portfolio?
Normally, what I would probably say is when you start getting in your 50s, because now you're starting to think about retirement. And there's some, right now with interest rates being where they are, these products have really excelled over the last year. They're really great for clients. But now you have something where it's growing for you. It grows tax deferred, and you don't have to worry about paying taxes to withdraw it. And again, if you're in that, what I would say is 10-year, that 10-year range of being able to retire, this is something that can really can help your portfolio and more importantly, create that income for you that you're going to need on a monthly basis in retirement.
And if you do like the 5 year, say, and then it's performing well, can you continue that into a 7? Do you have to get a new annuity?
So you can actually continue the contract.
Okay.
After that 5 years. The nice part about it is now it's completely liquid. So you can take
money out.
Maybe you wait 8 years or whatever you want to do. But after that 5 year, you're going to get some new rates. And you can either stay in it or you can roll that over into something else as well.
Okay, so there are options, yeah.
Right, and you can also do IRA money, Roth money, or just money that you have sitting in your bank account. So it doesn't really matter, what type of money you want to put into it. It just depends on how that's going to be taxed later on when you take the withdrawal.
Okay, all right, Cory, so if somebody has questions about this, they want to meet with you, what's the best way to reach out?
Best way is give us a call at 614-760-0670, or you can always visit our website at safeharboroh.com. We have an office in Dublin and Easton, and all meetings are complimentary with no financial obligation as well.
All right, perfect. Cory, thank you.
Thank you, Robin.